Welcome to Study Time, a televised home learning program produced by Rwanda Education Board.
Hello students, welcome once again to TV learning programs. As usual, I'm teacher Julius, and today I'm learning with Senior 6 class, Entrepreneurship. And still we are under our Unit 5, which is Financial Statements. Then our today's lesson, we are going to talk about financial ratios and interpretation. Financial ratios and interpretation. So, here you have to first understand what is a ratio, what is a ratio. Then, after knowing what a ratio is, then you shall be able to interpret different financial ratios. So, who can define a ratio? Who can define a ratio? So, a financial ratio, a financial ratio, when we talk about a ratio, so a financial ratio, this is just a mathematical statement. We shall be having some mathematical statements here which we shall interpret, of which the statements compare or show the relationship between the two financial statements. So this is a financial statement. This is a financial statement, financial mathematical statement, a financial mathematical statement, financial mathematical statement that shows relationship, that shows the relationship between two financial variables, between two financial variables or quantities, financial variables. So these financial statements, the financial ratios here, we shall interpret them. We shall, for example, compare the current assets and the current liabilities. When you compare those two financial variables of the business, then we shall be able to interpret. We know either current assets are greater than current liabilities. What does that one mean? If current liabilities are less than current assets, what does that one mean? So we have different types of financial ratios. And in this case, when it comes to types, we have to look at some types of financial ratios. Some of the types of financial ratios that we shall talk about under this. We shall talk about what we call profitability ratios. Profitability ratios. As our number one, profitability ratios. So what are these ratios? From the word profit. So profitability ratios, these ratios, they show the ability of the business to generate profits from the investment made. So these show, we shall just have these show the ability of the business, these show the ability of the business to generate profits or returns, to generate profits from the investment made, This is what you call profitability ratios. So under profitability ratios, we have many that we have to talk about. All these ones, they'll be rotating on one thing. What is the ability of the business to generate returns, to generate profits from capital invested or from the investment made? So here, we shall talk about what we call the margin ratio. The margin ratio. We call it gross profit. It can be gross profit. Some people call it gross profit ratio or gross profit margin. Gross profit ratio, which can be gross profit percentage. So this ratio, it is the gross profit expressed as a percentage of net sales. So this is gross profit. This is gross profit. This is gross profit expressed as a percentage. Expressed as a percentage of net sales. Therefore, from this, who can tell me how can we calculate the margin ratio or gross profit ratio, gross profit percentage? The margin ratio or margin, gross profit margin or margin ratio, we shall have gross profit. You get gross profit, then you divide by what we call net sales, then you multiply 100. When it comes to interpretation, remember net sales, these are goods sold. Net sales, actual value of goods sold, after subtracting what you call sales returns or return inwards. So in this case, we want to know each unit sold generates how much gross profit. If you have sold 10 cows and you have gotten maybe a profit of 1 million, out of selling 10 cows, you have gotten a profit of 1 million. We want to know each cow has contributed how much gross profit on the total gross profit generated. So each unit sold has got a contribution on the total gross profit generated. So this ratio, the margin ratio, the gross profit percentage, helps us to know each unit sold generates how much gross profit. So you have to understand this, so we shall be able to interpret. For example, if you get 30%, then you should know that each unit sold, each unit of net sales generates 30% as gross profit. That will be the interpretation when it comes to when we do an example. Then we have another ratio under this, which will be the markup ratio. We call it the markup ratio, or gross profit markup, the markup ratio. So what is this markup ratio now? This will be the opposite of this. Still, in this case, this is gross profit expressed as a percentage of cost of sales. Here we say that this is the gross profit. This is the gross profit. The gross profit expressed as a percentage. Expressed as a percentage of cost of sales. So how can we generate now the formula that we shall be using here with the gross profit markup? So markup, therefore, how shall we calculate it? Markup will be equal to gross profit. Gross profit. In this case, you divide by, because it is a percentage, it is gross profit expressed as a percentage of cost of sales. So you will divide by cost of sales. You will divide by cost of sales. Then you multiply 100. The answer will be in percentage. The answer will be percentage. Remember we talked about cost of sales. Amount of money spent while purchasing goods for resale. And the formula, you know, opening stock plus net purchases minus closing stock. Oh, goods available for sale minus closing stock. So in this case, we should interpret each unit bought generates how much gross profit. So we should be able to interpret the markup ratio after calculating this. Then we have another ratio that we shall talk about under this, which will be the net profit percentage, or net profit ratio. It can be the net profit percentage, the net profit percentage, or the net profit ratio, the net profit ratio. Remember, you all know how to calculate net profit. Net profit is equal to gross profit minus operating expenses. But when it came to, when it is a profit and loss account, we said that gross profit can be adjusted by adding other incomes if they are there. If a business has other sources where it generates other incomes are added to gross profit, and therefore it changes, it becomes gross income. You take away operating expenses like provision for bad debts or doubtful debts, depreciation values, salaries and wages, etc. Then you'll be able to get net profit. So here, this one, it is related to this. In this case, we are removing gross profit, we put net profit. Remember, gross profit is net sales minus cost of sales. So this is the net profit. This is the net profit expressed as a percentage of net sales still, percentage of net sales, expressed as a percentage of net sales. Therefore, you have to check here. Here we are considering gross profit. We have not taken away what you call operating expenses. So when it comes to this, net profit, that is actual profit realized by the business at the end of a given trading financial year. And therefore, here, how do you get this? The net profit ratio will be equal to net profit, you divide by what you call net sales, then you multiply 100. You multiply 100. In this case, you'll be able to get the net profit ratio. What will be the interpretation? We shall need to know each unit sold generates how much net profit. That will be the interpretation. Remember, financial ratios and interpretation, that's our lesson. So we shall have to know out of the net profit, if it is 1,000 as the net profit, each unit sold, if you sold 5, generated how much net profit. So we shall need to interpret this. So this is net profit percentage or net profit ratio. Then we have what you call rate of return on capital. Rate of return on capital. So rate of return on capital, this will be the ratio of net profit. This will be the ratio of net profit to capital employed or invested in the business. So in this ratio, we examine how much net profit each unit of capital generates. This ratio measures the efficiency on how a manager uses capital given to him to generate returns. And therefore, a high ratio here indicates that the manager used the capital given to him very well or efficient. There was no mismanagement. If maybe you get like 90%, that means capital employed was used very well to generate net profit. So this ratio, this is the ratio of net profit to capital invested or capital employed expressed as a percentage. Expressed as a percentage. Expressed as what? As a percentage. So it measures the efficiency. Now a manager uses capital given to him to generate net profit. Therefore, how do we calculate this? Rate of return on capital, rate of return on capital invested. This will be net profit. We shall get net profit divided by capital employed or capital invested. Then you multiply 100. A higher ratio indicates that the business is doing well. The manager or you, the owner of the business, the sole proprietor, you are using your capital efficiently. There is no mismanagement. Hope that's okay. Then there are many ratios. So I want us to look at, again, what we call the liquidity ratios. Liquidity ratios. The liquidity ratios has category number 2. Here we have talked about profitability ratios. Though there are many, we can give more. Now let's look at liquidity ratios. What is liquidity from those who do economics? Liquidity, that is ease with which assets can be turned into cash. So with these liquidity ratios, we are looking at liquid assets. You know how to get liquid capital. How do you get liquid capital? Liquid capital is equal to the sum of current assets minus closing stock. So in this case, these liquidity ratios, they measure the ability of the business to meet its short-term financial obligations using its current assets. Now you should be able, from the balance sheet now, you know what current assets are and what short-term financial obligations are. Those are current liabilities. Therefore here, liquidity ratios, they measure the ability, the strength of the business to meet short-term financial obligations like current liabilities, bank overdraft, short-term loan, unpaid expenses, prepaid income or income received in advance. How does the business respond to such a current liabilities? Using its current assets like cash at hand, cash at bank, prepaid expenses, unpaid income, debtors or accounts receivables. So here we shall say that these ratios, these measure, you can say, these measure the ability of the business, the ability of the business to meet its short-term financial obligations. These are current liabilities, learners, short-term financial obligations, using its current assets. Using its current what? Its current assets. Therefore here, under these are liquidity ratios. We have two major ratios that we use to measure the strength of the business. So we have what you call the current ratio, working capital ratio, or current asset ratio. Those are three names that mean one thing. So we have the current ratio. The current ratio is the same as current asset ratio. Current asset ratio, or some people may call it working capital ratio. Working capital ratio. So this ratio, it is the ratio of current assets to current liabilities of the business. So this is the ratio. This is the ratio of current assets to current liabilities of the business. So now you should be able to know what are current liabilities and what are current assets. Current liabilities of a business. Current liabilities of a business. How do we get it therefore? It means that our current ratio is equal to current assets. You get current assets, you know examples. Current assets, you divide by current liabilities. In this case, you will compare what two. We shall be able to know, is the business in a good financial position to clear its current liabilities using its current assets? And here we shall talk about introduce concepts like solvency and insolvency. If the business current assets can clear its current liabilities, the business is solvent. It is in a good financial position to pay off short-term financial obligations like accounts payables. Those are sundry creditors, bank overdraft, short-term loan, unpaid expenses or outstanding expenses, and prepaid income or income received in advance. If the business can meet them, can clear them off using its current assets, then the business is solvent. It is in a good financial position. That is current ratio. Then we have another ratio that we shall talk about, which is acid test ratio, quick asset ratio. So this is acid test ratio. The acid test ratio examines the most liquid resources of the business. Most liquid resources of the business. So this one, so this is the ratio, we said this is the ratio, this is the ratio of the most liquid resources of the business. Most liquid resources of the business to the current liabilities. To the current liabilities. To the current liabilities. To the current liabilities. What do we mean by most liquid resources of the business? When you talk about liquidity, the ease with which assets can be turned into cash. That's what we call liquidity. And therefore, when we look at current assets, cash at hand, cash at the bank, sundry, trade debtors, that is accounts receivables. Talk about prepaid expenses. Then talk about unpaid income, outstanding income, accrued income. So if you look at them, which one can be turned into cash? Most liquid resources of the business. In this case, we exclude closing stock. Closing stock, we exclude it when it comes to this ratio. We don't consider it. And therefore, asset test ratio, the asset test ratio, you will get your current assets, then you subtract closing stock, of which closing stock is one of the current assets, meaning that you can you neglect it. Closing stock, then we divide by what we call current liabilities. These are short-term financial obligations, current liabilities, the current liabilities. So when you get current assets and you subtract closing stock, you will get what you call most liquid resource of the business, or quick assets. Quick assets, those which can easily, or whose liquidity level is very high, they can easily be turned into cash. So we exclude closing stock, the stock available at the end of the trading financial year or trading period. That stock at the end of the given trading period, when we are using this ratio, then it will be excluded. Remember, these financial ratios, they are very important. They help in financial decisions. First of all, they help to know whether the business has the ability to pay its current liabilities using its current assets. And therefore, if you find that current liabilities are greater, you have to look at ways how you can try to minimize them. That one you must know. That is one of the importance of these financial ratios. They help to show whether the business is solvent or insolvent. Solvency, the business is in a good financial position. They may help you in planning how to manage your business, how to control it. They measure the efficiency. So they reveal some errors even in the business. Inefficiencies with these ratios are revealed or disclosed. And you may base on these financial ratios, then you take what you call financial decisions. So under liquidity ratios, we must use these two to measure the strength of the business, to pay its short-term financial obligations using its current assets. So I want to leave you with some work which I want you to do. Then when it comes to the next lesson following this, we shall be able to give out a question. Then we see how we can calculate this and we interpret. So what matters here, you must master these formulas. You must get these formulas and you know what does this ratio help us to find out. So this is some work that I want you to work out, and see if you can very well explain this. So my question number one, which I want you to work out, I want you to explain the following ratios, showing how they are used in the business, how they are used by the business, In this case, when you explain the profit margin, tell me what does it measure, what does it from the explanation given, or from this. I expect you to find out that, like the profit margin, it shows how much gross profit each unit sold generates. Each unit sold generates how much gross profit. So part A, we have the, I can say, markup, that the markup ratio, the margin ratio or the gross profit ratio, the margin ratio. Talk about the net profit ratio. The net profit ratio. Then I want you to talk about the rate of return on capital. Rate of return on capital employed or capital invested. On capital. Then talk about the current ratio. The current ratio. Then I want you also to talk about the acid test ratio. The acid test what? Test ratio. Remember, these are categorized into two. We have talked about the profitability ratios, the liquidity ratios, even we have what you call beverage ratios, which we shall look, which measure how the working capital works. So I expect you now to explain this and be able to know each ratio shows what, each ratio measures what. Because we shall base on that and we interpret. Given current assets as maybe if the business has current assets worth 1 million and current liabilities worth 800,000, if you are to get that ratio, the answer that you get, what does it mean? If current assets are greater than current liabilities, then the business is solvent. It is in a good financial position. It is in a good financial stand to pay its current liabilities using its current assets. Thank you very much, learners, for watching and listening and following this lesson that we have had for these 30 minutes. Thank you. So we meet next time in the next lesson. Bye-bye.